The Indian chemical sector enjoys a market size of almost $180 billion, covering over 80,000 commercial products, and it makes up 3.4% of the global chemical industry. Amongst the different categories, the fastest growing is specialty chemicals, which at a 22% market share is anticipated to reach $64 billion by 2025 and somewhere close to $300 billion by 2040. From a trading perspective, specialty chemical accounts for more than 50% of India's chemical exports, and from an investing perspective, after many years of stock price growth, you can now see some pockets of opportunity. Specialty chemicals is a big topic, but if you don't know much about it, then you'll find this video a good starting point. The video itself is divided into two parts, and in part 1 we'll understand the basics of what specialty chemicals are, the China+1 effect, the factors that are helping India, etc. And in part 2 I'll take you through some key parameters and metrics one needs to look out for when evaluating a specialty chemical business. This video was a lot of work, a lot of reading actually, and to help you out I've added some of those links in the video's description. Let's begin. Specialty chemicals are often referred to as performance or functional chemicals and are used to provide a specific outcome in the manufacturing process that they are used in. For example, I am sure you would have heard of polytetrafluoroethanol that goes with the trade name Teflon, which is a high performance fluoropolymer that is known for its exceptional non-stick properties, resistance to heat, and chemical inertness. Now, this polytetra or Teflon, when it is integrated into the manufacturing of cookware like a frying pan, it dramatically transforms the product's functionality, and that's what a specialty chemical is expected to do. Another example is that of sodium lauryl sulfate or SLS, which is a surfactant and is found in personal care products like shampoos and toothpaste. The SLS acts as an effective foaming agent and emulsifier that enables an even distribution of the product during its use, which leads to better cleaning and improved texture. So essentially, specialty chemicals provide a specific attribute to a product, so they have a very precise use, and the usage itself is in very small quantities in the final product. Now, specialty chemicals are of many types, and they range from agrochemicals to dyes and pigments to polymers, surfactants, textile, cosmetics, construction chemicals, flavors and fragrances, etc. As one might expect, every category caters to different industries, it has a different margin profile, its own competitive intensity, market potential, etc. For instance, segments like nutraceuticals, flavors and fragrances, and also water and construction chemicals are expected to have a higher growth trajectory as compared to dyes, pigments and polymers. I'll explain later in the video which Indian company is into what, but as an investor, I hope you can understand the importance of knowing which subcategory a specialty chemical company or companies falls into before you invest in it. To put it differently, I think the term specialty chemical is being abused to some extent, and I even came across a couple of companies who proudly call themselves specialty chemical producers, while what they are actually formulating is a basic and simple commodity compound. Okay, let's address the elephant in the room, or might I say the dragon in the cave, and we're definitely talking about the China+1 strategy that I'm sure you've heard so many times that you're thankful कि भगवान ने हमें दो कान दिए. Now, China is the world's leading specialty chemical exporter, with India exporting just a fourth of what the Chinese do. This dominant position was achieved on the back of lower labor costs, high subsidies on capital, and relaxed environmental norms, but lately all these advantages are dwindling. For instance, there's the changing global trade dynamics with many countries trying to reduce their dependence on China. The environmental norms are very stringent now, which has led to relocation of plants and therefore higher operational and capital costs. Point 3, the labor cost in China that was lower than that of India until 2007 has ballooned up. There has been a withdrawal in many subsidies, and the Chinese government's introduction of a green tax based on solid waste production has put a serious dent in China's cost competitiveness. So all this has led to global chemical companies wanting to diversify procurement away from China, which is what the China+1 strategy is, and countries like India are now seeing a big opening. In response, several Indian companies have increased plant capacities over the last 4-5 years and have even set up global-sized plants to cater to growing domestic and international demand. In fact, the Indian specialty chemicals industry enjoys significant competitive advantages around the availability of low-cost skilled manpower, strong process engineering capabilities, growing R&D facilities, relatively strong IP protection vis-a-vis other emerging countries, a vast improvement in ease of doing business, let's not forget the tax reforms, improving transportation infrastructure, improving demand from the end user industries, both domestic and international. And finally, we have to thank the Indian government for giving this sector a serious push with initiatives like the Petroleum, Chemical and Petrochemicals Investment Region Policy and of course Production Linked Incentive or PLI schemes. And speaking of thanks, on behalf of the Fisdom Academy, I would like to thank everyone who made it to the Ignite event at Jaipur. I sincerely hope you found the masterclass sessions by Rishikesh, Vijay, Jyoti and Sanket a wonderful learning experience, and for those who missed it and are keen to learn, we'll ensure these sessions are made available on Fisdom Academy over the next 2 weeks. In the meantime, do check out the many paid and free courses on stock investing and trading, and if something seems interesting, then use the code SKN20 for a 20% discount on any of the paid courses. As always, the link to Fisdom Academy is available in this video's description. Okay, we now come to the second part of this video, and specialty chemicals is a vast area of inquiry with dozens of Indian companies and many variables to consider. I would say, unlike my previous videos on sugar, cement, IT services or the life insurance industry, analyzing the entire set of specialty chemical companies across singular metrics is a perfect recipe for disaster. You'll understand more as we go along, but to help us make sense, I have divided my research into 5 broader categories. The first of these is end user application, and as we discussed earlier, there are many subcategories within specialty chemicals, and companies tend to participate in 1, 2 or a maximum of 3 such areas. Which means when comparing companies, it's important to understand the final application of the molecule that they have designed. For example, companies that are into dyes and pigments, so companies like Atul Limited, Sudarshan Chemical, etc., well, these are definitely not the fastest growing ones and typically offer a 10% sales growth. On top of that, the dyes and pigment business is also a bit cyclical, which means the EBITDA margin of these companies do get disturbed from time to time. In that context, and as we see it in the case of dyes and pigments, as an investor, one has to be extremely careful to not confuse a company that actually formulates a specialty chemical with a company that's doing mundane work. However, on the other end of the spectrum are companies that make formulations for the food and beverage industry, personal care, health, nutrition. So basically huge and growing markets both in India and abroad. And this is where companies like SH Kelkar, Clean Science and Technology, Alkaline Amines, Oriental Aromatics, etc. are likely to have an edge. My point is the end use application is very important, and try to give preference to specialty chemical companies that are maybe small now but are addressing a large and growing market. As a matter of fact, an interesting trend to understand here is that of fluorine chemistry. So globally, there's a shift happening from the use of chlorine, which is considered dirty, to a cleaner chemical like fluorine, and this is a shift that's already happening with fluorine replacing chlorine molecules, especially in the pharma and personal care space. Understandably, this is where companies like Gujarat Fluorochemicals, Naveen Fluorine International, and also SRF come in that have been using these tailwinds to grow their sales and profits at an accelerated pace. A third related point within end user application is industry specialization. Now, as it happens in most industries, in the pursuit of growth, companies start expanding into newer areas, and this is absolutely fine. But when it comes to specialty chemicals, companies can either expand into newer chemistries or they can remain in a particular chemistry and build multiple products around it. Now, I've watched a couple of analyst interviews, and the second option, that is more products within a single chemistry, is the more preferred option, and companies like Naveen Fluorine and Poshak, which is India's largest phosgene-based specialty chemicals manufacturer, are absolute champions in this domain. Of course, the specialization need not be a firm rule, and diversified players like Vinati Organics, SRF and Aarti Industries have also done very well. But if you're looking at a smaller company, then opt for one that hasn't spread itself too thin, because then it becomes next to impossible to be a cost leader in one's chosen molecular domain. So this was a very long section, but to quickly recap, opt for companies with large and wide end user applications. Secondly, try to participate in a growing trend as we saw with fluorine chemistry. And thirdly, give preference to industry specialization. The second point of consideration are the entry barriers. Now, specialty chemicals are used in very small quantities, but as we saw with the Teflon example, they have a very high impact on the end product's final properties, which is why customers of these products are very particular about choosing the right supplier, which often includes very time-consuming and rigorous testing before onboarding a new supplier. And these customers most definitely do not switch suppliers over minor price differences. An example of this is when Deepak Nitrite started producing and marketing an optical brightening agent, and in spite of having a low-cost product, they weren't able to convince enough textile or paper mills because even the slightest change in color or even the perception of it might have led to a loss of millions of tons of cloth or paper for those mills. In other words, the cost of switching is extremely high, and for this reason, many specialty chemical producers are somewhat protected from intense competition and they get pricing power, wherein any increase in input costs can now be passed to their customers, making them price setters and not price takers. From an investor's point of view, companies with a high number of active customers are always welcome, and the more they add to it on a quarterly or annual basis, the better it is. For example, Naveen Fluorine International, as of 31st of March 2023, had 846 active customers in its roster, and the tracking of this number on a quarterly or even a half-yearly basis will give you a good idea of where the company is heading. Again, as we saw in the previous section, and although I've labeled this section as entry barriers, we've covered multiple stuff here, including pricing power, switching costs, and the number of active clients, all of which are necessary for any investor to consider when evaluating a specialty chemicals business. The third variable in my list is the amount of growth capital expenditure undertaken by a company. So Indian specialty chemical companies have been doubling their capex every 5 years, and it's a trend that's likely to continue for a few more years or at least the next 3 years, with most companies committing to an adequate increase in capex. Now, when I add domestic consumption, China+1, R&D efforts, the export market, etc. on top of the capacity growth, it won't be a surprise if, as a sector, specialty chemicals end up delivering an 18 to 20% earnings CAGR over the next 3 to 5 years. So this was the broader view, but it's also important to understand what different companies are individually doing, and R&D Industries is definitely leading the charge with an expected capex of 2,500 to 3,000 crores over the next 2 years as it looks to expand and upgrade its manufacturing facilities. Similarly, companies like Atul Limited are likely to incur a capex of around 550 crores this year, and even others like Deepak Nitrite, Gujarat Fluorochemicals, and Alkaline Amines have committed a decent amount towards capacity expansion. As investors, another key but relatable number to watch out for is how this capital expenditure will be financed. For instance, while R&D Industries will be using the $130 million it has borrowed from IFC, Atul Limited is planning to finance its capex via its internal accruals, which is obviously a lot less riskier and generally a welcome move from an investor's perspective. Now, while spending money on capex is about giving the company some muscle, the soft power, the real power in a specialty chemicals business is in its research and development. As an industry, the average R&D spend in India as a percentage of revenue is between 3 and 4%, while in developed economies and even China, this number is upwards of 15%. So this is quite a difference, but things are changing, and the specialty chemical industry as a whole is likely to increase its R&D spending to at least 6% of its revenue over the next 4 to 5 years. In fact, let's take this point a layer deeper, and what an increase in R&D expenditure means is that Indian companies will now have the capability of creating more complex and heavier molecular structures using advanced process technologies. This in turn means that not only will the older products be replaced with complex chemistries, which translates to more business, but it also seems to suggest that the major cost component going forward will not be the raw materials, which is the case today, but it will be these complex technologies. This is definitely something for all investors to consider when creating an investment thesis. And when I look at it broadly, many Indian specialty chemical companies have started to take progressive steps in that direction. If you want to study this a bit further, then definitely look at what PI Industries, SRF, and R&D Industries have been doing and are continually doing to improve their R&D capabilities. So to put this as a 3-point exercise, try to find companies that have the ability to consistently find new products, companies that can develop command over new and complex chemistries, and can also incrementally optimize their existing processes to improve their profit margins. The final box, and a very important one, are the financial metrics, and there are three key variables to look at. The first are the growth metrics, and the sector as a whole has experienced significant sales growth of about 18% over the last 3 financial years, and it's a number that's likely to continue for a few more years, making 18% an adequate benchmark when evaluating companies. Additionally, it also helps that most companies have undertaken significant capex in the last 3-4 years, and they continue to build their capacity, which will have a positive impact on the sales and profits of these establishments. The second financial metric to consider is profitability, and the margins for most companies saw big improvements in FY21 and FY22 due to supply chain disruptions, and although these margins have now moderated, the operating profit margin continues to hover around 18% for the industry heavyweights, and it's likely to remain there for a few more years. From an investor's perspective, a stable and high margin, preferably in the high teens or 20% plus, is always welcome, and one should always factor that margins are a function of the category a company operates in. For example, the operating margins for amine manufacturers often stay within the 16 to 24% band. The average agrochemical company is between 14 to 22%. Fluorochemical companies are a bit higher, 25-28%, while the margins for paint-related chemicals and pigments have been seriously impacted due to a slowdown in the demand for paints and the imposition of anti-dumping duties by China on imported pigments. An interesting corollary to operating margins is that they also help in explaining if the company's pricing power is intact or not. In other words, if the profit margins of a specialty chemical player starts declining, that may well be an indication that the so-called specialty products has now started to become a commodity product and has therefore started losing its pricing power. And the third financial metric to look out for is leverage, and as it stands, the capital structure of many specialty chemical companies looks comfortable. When I look at it from a gearing ratio perspective, the capital structure of amines is very healthy, and so is the case for paint-related chemicals which have not undertaken any major capex over the last few years. At the other end of the spectrum are pigments, where the overall gearing is on the higher side, and it's really a double whammy because while the companies did a lot of capex in recent years, their operating profitability has been negatively impacted due to the industry cycle. So these were 5 major variables that I think every investor who's invested or wants to invest in a specialty chemical companies should consider. And if you're wondering why there isn't much data that you've come to expect from my industry analysis videos, then that's because I've already started working on a follow-up video where I'll be taking the learnings of everything we've discussed in this video and I'll be applying it on 7 to 8 different specialty chemical companies. I'll try to post that video over the next 2-3 weeks, but to quickly recap, the Indian specialty chemicals market is worth about $40 billion and is expected to grow at 12-13% for a few more years. The major drivers for the same are domestic consumption, China+1, exports growth, and policy push from the Indian government. Specialty chemicals in itself is an umbrella word and includes different subcategories that have their own market size, end user applications, margins, and growth potential. We are seeing acceleration towards chemicals, and we took example of fluorine chemistry in this video. The specialty chemicals business comes with significant barriers to entry in terms of high switching costs and R&D expenses. Sales growth is a function of capital expenditure, and specialty chemical companies within India have and are continually investing in increasing capacity. And we rounded the discussion with an interesting observation wherein a company's operating margins can be a good indicator of when its product is more likely to become a commodity. So that's it for this video, and if you found this video useful, if you found it informative, then do let me know by tapping in that like button and also leaving behind a comment. Once again, thank you for your time, and I'll see you 3 days from now. Until then.